I'm joined by Jeff Harte, senior bank analyst with Piper Sandler. Jeff, good to have you. And I mean, why is sentiment so bad? Is it just the recession concern?
I think that's probably the primary driver. I mean, where we're sitting is interest rates are clearly a tailwind, but it was kind of an expected tailwind. So coming into the year, bank stocks at least had some higher rates kind of priced in. They're materializing, which is good, as opposed to being expected. What's changed, though, is, especially with the war in Ukraine and how much inflation has stepped up, there's growing concerns that we're going to be heading into a recession and therefore a spike in credit losses. And I think that's really what's weighing on the banks. And it's really been the kind of difference maker, I think, for bank stocks the last couple of months, probably. Yeah, and
understandably, investors don't want to have to be the ones who call the recession thing correctly, and so therefore they're just staying away from the space. But there's plenty of people who think this is a valuation correction more than it is an actual recession that's looming, at least in the near term. I wonder if one of the other problems for the banks, though, is actually their labor costs. I mean, this is an issue going back to what JPMorgan said at the turn of the year.
Well, certainly there's labor inflation all across the economy, and the banks have seen some. I think actually, especially for anybody involved in investment banking, last year was such a good year, and trading as well, that you probably had some artificially elevated comp expenses last year that won't be as bad this year. So I think the expense outlook's probably not going to be as big an issue. But at the end of the day, when you're investing in financials, you have to have a macro call, like it or not, because they're very closely tied to the economy. And if your macro call is we're heading to a recession, you want to stay away. If your macro call is, the Fed's not going to hike as much as the market thinks and the economy will keep growing, all of a sudden these banks are I think, looking pretty attractive with a lot of bad news priced in.
Well, I feel like from talking with you in the past, you like the big money center banks typically, but who are your favorites right now? Who do you think is best positioned for this environment?
I mean, I find myself coming back to the big universal banks, right? Bank of America tops my list. JPMorgan's there as well. If we actually do go into a recession and credit costs spike, these guys have the scale, rather uniquely, the scale to really defend their bottom line, but to also then go out and maybe be offensive and gain some market share kind of while others are struggling. If, on the other hand, the economy turns out to be okay and we don't go into a recession, I mean, these guys are levered to interest rates, they've got loan growth, and they're levered to capital markets. So I kind of think sitting here today, that the safest place to be, whether you're bullish or bearish, if you're going to be in bank stocks, is a company like BofA or a company like JPMorgan.
It seems like the problem is it's not even if I could tell you whether or not we're entering recession and in what month. I would have to tell you this is when the chatter about it stopped, because until the chatter stops, it's not going to go away as a concern weighing on their performance, is it?
No, that's true. And I think what we'll have to probably see is a slowing of the inflationary pressures. I do think we will see kind of as we get into the back half of the year, but, some slowing in the inflationary pressures and certainly any positive news on kind of the war front in Europe. I mean, it's not easy to forget, but I mean, that's a major headwind. If we could kind of get some kind of a truce or peace in Ukraine/Russia and get some headwinds from the inflation side really kind of dialing back a bit, that could be what it takes to kind of get people in. Because you're right, as we sit here today, we're still seeing loan growth. That's good. We're seeing high rates. That's good. But, that macroeconomic outlook really seems to be what has the market kind of scratching its head.
No, it's a great point. And you're right. We haven't talked that much about the Ukraine issue lately. Jeff, thanks for joining us today.
Good to be on. Thanks.
Jeff Harte.